Ladies and gentlemen, welcome to the Safety and Risk Success podcast. I'm Christian Harris, and I'm delighted to see you on another episode. My guest today is Chris Gill. Chris is someone I've known and worked with for a number of years, and as he'll tell us, he's had a varied career involved in safety and risk management, from insurance risk manager within a business to working in a brokerage, then to a large insurer, and now as a supplier to the insurance and risk space. So I thought he was the perfect person to get onto the show to talk about what he calls, and I've often referenced, the biggest hidden secret in safety and risk, which is insurance risk management bursaries. Fundamentally, there is money available from insurance companies to pay for risk reduction or risk management activities. So, for example, in my world of slip safety, we can often get our slip testing work funded by insurance companies, which means that for clients, this can often be done totally for free. So that brings a lot of value, gets them on the journey of starting to reduce their risk, lower their accident numbers, have fewer people getting hurt, and of course that has a knock-on effect on the volume and value and the defensibility rate of any claims that they might receive. So with Chris, we're going to dive into detail on this topic, talk about how you should approach it if you're a client, but also how both brokers and insurers approach this topic, and I'm sure you'll get a lot of value from this. Let's crack on with it then and get into my conversation with Chris Gill. Chris Gill, welcome to the podcast.
Thank you, Christian. Good to be here.
We've done an interview before, but not on the podcast. So it's good to have the opportunity to chat to you again. And we're going to do another episode with your colleague about your current business. But I was keen to get you on to talk about risk management bursaries specifically. It's a topic that I've mentioned to a lot of people, and surprisingly, many corporate clients haven't ever heard of it. So I thought an episode where we kind of explain a bit about it and what the benefits are and how it all works would be useful. And I'll ask you in a second to give a bit of your background, but I thought you were a very well qualified person to talk about it.
Thank you. Bursaries are probably the biggest kept secret and one of the most interesting opportunities in insurance, particularly for a customer. So it's good to be able to talk about it and to help people understand the opportunity that's there today for them.
Yeah, definitely. Do you want to give a bit of context then in terms of your background, roles you've done, and kind of so people can see what perspective you bring?
Sure. So I've really walked all paths of life within insurance. I started off as a risk and insurance manager for a bus and coach company, where one of our insurers was a major insurer in the market, and I worked with them on accepting bursaries and risk management around telematics for vehicles, and then health and safety of drivers. So first of all, got to see the industry and the opportunity from the client perspective.
Yeah.
I then joined Willis Towers Watson back in 2012, where I worked as a risk management exec. That was the client-facing arm of Willis Towers Watson, working with Willis's clients themselves across the health and safety practice and motor fleet as well.
Yeah.
Helping clients to improve their risk profile, both at an enterprise level and at a hazard level. In particular, health and safety, working on slips, trips and falls, and the typical hazards that come with that. In 2014, I was hired into QBE, which is a top 10 global insurer, specializing in business risk. I worked there as the head of risk solutions, where I oversaw all of the product lines for casualty, which is the health and safety, property risk, motor fleet risk, and the financial lines. And I looked after that across the UK, mainland Europe, Dubai and Canada, and in total that covered approximately about 2.8 billion US dollars of gross written premium. So I'm very well versed in working with major brokers and mid-market brokers, working with other insurers, because of course clients don't always necessarily just have one insurer, they can have multiple insurers, so collaboration, And this has afforded me the breadth of insight across the industry over the years to be able to appreciate the landscape and the opportunity for clients, brokers and insurers, having worked in each of them.
Yeah.
More recently, during my time at QBE, I worked a lot with technology companies who are entering the market to transform the way that insurers operated by better using data and technology to drive innovation.
Yeah.
In recent years, I've now moved into the technology market, but working very closely with brokers and insurers.
Yeah. There you go. So a full gamut of experience from all the different angles. So yeah, hence why I thought you'd be a good person to talk about this. So so clearly, anybody working in safety and risk understands fully the human cost of accidents and risk. If we're talking about things that result in harm to humans as opposed to, say, financial risks. So nobody wants accidents to happen. But I think there's potentially a perception sometimes that insurance companies like claims. What would you say to that?
I think first of all, there's a language that unites everybody, which is risk. It's unforeseen or unwanted events that occur that results in a loss, whether it's a loss to a person's health, well-being, potentially their life, property, motor, whatever it is, and whether that transpires as reputational damage to a company, a claim to an insurer, a loss to a family. There's the simple fact that there are unwanted events that occur, and everybody in the ecosystem of insurance and the client themselves at the center of this are incentivized to try to avoid that and try to reduce that as much as possible. And I suppose what we're looking at, what we're talking about today is, are there misalignments in that ecosystem which aren't quite working well enough or as good as they could be to help each of those parties to better manage risk down?
Yeah, that makes sense. So I think I said there's a perception because that insurers want claims, because I know they don't, because your premium is the expected claims, in very simple terms, the expected claims plus a margin to cover their overheads and a bit of profit. So if they could have more certainty about the claims cost being lower, then they can still maintain their margin, but the premium can be lower and everybody's happy. So I do think there's some misunderstanding, should we say, about that. But yeah, your point about kind of misalignment is a good one, because you've got, if you think about it, if you're the client, you've got your broker and your insurer, who are both playing fundamentally different roles and have actually slightly different goals and ambitions. But from a client perspective, they're they're arguably interchangeable in many ways, or you think they'd be sitting on the same side of the fence. So how do you see that juxtaposition?
I think so. Everything starts with a claim, because if you can control claims, you control the premium. And the way that works is about 80 or 75 to 80% of a premium is made up of claims. So very typically and very simplistically, around 70% of your premium will be made up of attritional loss, which is your high frequency claims. Things like slips, trips, falls, manual handling, things like that. Usual cost of a claim is usually about 10 grand, £10,000. You'll have about 5% of that premium allocated to large or catastrophic losses, which will be very severe accidents, typically resulting in a paraplegic injury as a result of an accident. You then have roughly about 20% allocated to insurer expenses, and then there's about 5% profit, because obviously the need to keep the lights on and to keep running the business. So if you look at the breakup, 70% or 75% on claims, if you can control the claims frequency and the claims defensibility, you manage your premiums better. Now, there's lots of market forces that drive a premium, and I won't get into that today because it's quite a complex.
That's a complex topic. Yeah, I've actually got a couple of people potentially lined up to talk about the insurance cycle and market conditions and things, because it's a fascinating topic, but quite an in-depth topic.
Yeah, I think this will segue quite nicely into that. But yeah, absolutely. Many companies, or if not all companies that I come across, want to reduce injuries and they want to reduce hazards. Insurers want to reduce claims so that they can get a healthier profit margin for clients through their premium. But potentially where there are misalignments are access to bursary money, which is of the insurer expenses, that there is usually an amount allocated for investment into their clients to try and reduce those two claims areas, which is either claims frequency or potential for catastrophic or large losses.
Yeah, that makes sense. And what's the role then of a broker? Because obviously the insurer is the one who's got their money on the line, and can invest some money in trying to reduce the risk. The broker kind of sits in between that and obviously the client, giving them advice and adding value in various ways like that. But from a risk management perspective, thinking about bursaries and things like that, how does the broker, what role did the broker play there?
So you're absolutely right. The broker's role is about the total risk transfer. So the broker consults with the client to understand, of 100% of risk to the business, what portion of risk do you then need insurance for? And then what portion of risk is then retained within the business? Then where are the losses potentially going to come from? So the broker has an intimate understanding and appreciation for the customer's risk to help them, if they don't know, where their potential losses may come from an insurer's perspective, and then to, if you like, act as an intermediary between the client and the underwriter to help get any investment by way of bursary, to try and help manage and mitigate that risk. There are usually two methods of funding from an insurer. There's the bursary money, which is, if you look at it as an upfront investment to manage risk, and it's usually a one-off fee and delivered as a risk management project for a customer. And then you've got a return of premium, which could be where the insurer sees that at the end of a policy period, they had fewer accidents or fewer severe accidents, and so they may reimburse. But the broker is typically there, as I say, to help the customer understand their risk. They also have certainly in large and mid-market brokers, an allocation of resource to help the customers understand that. So they have their risk management consulting arm, which goes in either at an enterprise risk level or at a health and safety, motor fleet level or property level and facilities to help them learn and understand their risks and again report that back to the underwriter.
Yeah. So but bursary, as you say, is a bit of a hidden secret, and that's certainly something that I see. It's a question I ask to health and safety managers or people like that in businesses, and they often say, "Oh, what's that? I've never heard of it." So what would be the best way, if you're in that position, listening to this, of kind of getting to understand whether a risk management bursary is something that's available to you?
So the first person to speak to would be the broker. So if you're in a health and safety role within a business, it makes sense to speak to the person that's responsible for buying insurance for your company. So you could, if you're in a large company, perhaps speak to the risk and insurance manager, could be the finance director. And those individuals will usually have the relationship with the broker that places insurance for you. I'll ask him to speak to the broker about your own department or your own area in order to be able to help you deliver your job and protect lives and reduce accidents. Makes perfect sense. And then speaking to the broker and explaining where you are in your position and what it is you're trying to accomplish, where you see accidents and near misses coming from, and how this could give rise to a potential claim. And then it's a conversation that the broker can take to the underwriter about how, if there's an opportunity to fund this through a bursary, and if there is opportunity to fund, what would be the best way of funding it. and then who would be best placed to deliver that funding.
Yeah.
That's a bit that we can come on to in a moment, is how is this money actually intended to be spent.
Yeah.
But in the first instance, getting access to the money, find who buys the insurance, ask to speak to the broker, and then have that conversation with the broker about the opportunity.
Yeah, and in my experience, I've found that if you have that conversation with the broker and you have some worked up thoughts in your mind and a bit of structure around it, then that's very well received, because that shows that you're being proactive and you're wanting to do something to reduce that risk, and the broker is clearly going to support that and have a conversation on your behalf with the insurer.
Definitely, I think everybody accepts that that there is risk to business, either at a people, property, or asset level, or across the piece. And it's about managing that risk down. And as I said at the beginning, everybody has a stake and a responsibility to help that risk reduction process.
Yeah, no, definitely. So you have that conversation. You get some positive feedback from the underwriter at the insurer. What's the next phase? Is it then about what do you do and who does it?
So everybody is. So I suppose a client will always want an expert or the best person in place to help deliver. And depending on what the risks look like, typically you're more likely to get funding for the higher loss areas resulting in claims. So typically in the industry, the highest claims causation is slips and trips and falls, as you know, being the expert in that area. Secondly is typically manual handling, and thirdly is hit by a moving object, which is a terminology used by insurers for tracking claims. So they're the top three loss causations, but it's certainly worth actually speaking to the broker or the insurer if you don't know, and understanding what your claims history is like, because often as a health and safety manager you'll see and have absolute sight of the accidents, but accidents and even lost working time doesn't always necessarily transition into the claims experience.
No.
So it's finding, because insurers want to invest into where their losses are, where losses are occurring. A good example of this, where there is absolute difference between the two, it is in mental health. So mental health in the UK from the HSE is suggested to be the largest causation for lost working time in a business. But from an insurer's perspective, there are very few mental health claims for various reasons. It's difficult to place blame and things like that, and evidence and so forth. So claims don't really transpire, so that there can be disparity between the priorities of a health and safety manager and the intentions and the wants of the insurer. So first of all, it's important to understand what those differences are, and it may draw you into a conversation around negotiation to try and progress your ideas and your needs with the insurer. But often I think you will find that the two correlate. If people are hurting their backs and things in the workplace, then you're probably going to have higher manual handling claims and so forth. It's quite simple. Now, in terms of who delivers the work, typically, as I said, the broker will have a risk management consulting arm, and that consulting arm usually covers off the enterprise risk for the company, so the totality of risk, looking at claims defensibility, looking at risk modelling. Occasionally it does delve into the hazard area of the business where claims do arise. Your insurer will also probably have a risk department as well, which is there to try and help you. And occasionally the risk department from the insurer may come and visit sites within your business to conduct surveys, which is very much like a health and safety type audit. It's looking at what the exposure is relative to the hazards within the business, and then making some recommendations. If you're in a large organisation, that kind of activity may be happening in pockets of the business, but you might not necessarily know about it. So again, it's always worth speaking to the economic buyer of insurance within your business, because they should have a sight of all activity and the budget there to help guide this.
And the insurers and the brokers will often have kind of panels of third-party approved experts or suppliers. So yes, the broker may wish to deliver certain elements of a bursary project. So things like claims defensibility training. Typically, a broker would want to deliver that themselves. But if it's something like manual handling training or doing some slip testing like we would do, then they don't have that capability. So they'll look to get a third party in to do that. That raises an interesting point actually around, there are two sides to this from an insurer perspective or a total cost of risk perspective, which is the best way of looking at it. There's frequency of claims, so can we reduce the number of accidents that lead to claims? And then there's the defensibility side. So if we're going to get 10 claims, can we defend 7 of them rather than 6 of them, and therefore we end up spending a lower amount of money? What, in your experience, do most bursaries get spent on? Is it the sort of prevention bit, or is it the defensibility bit?
So probably a bit of both. It is absolutely split, and the two kind of go hand in hand. And the reason why they go hand in hand is because if you're managing down the frequency of claims, you're looking at how you're capturing near misses and how you're learning about hazards within your business. As you are capturing near misses and learning about hazards within your business, you should naturally be looking to try and improve the learnings of those two areas. As you improve the learnings of those two areas, you naturally improve the risk profile in that space. As you improve the risk profile, you improve defensibility. Defensibility is all about evidence to say that we did the right thing. We went as far as reasonably practical. And the frequency is about understanding where your hotspots and hazards can occur and being proactive and doing risk mitigation to try and avoid those losses in the first place. The two go hand in hand. And so I'd say that the spending is probably anecdotally around 50-50. But it does lead to an interesting point. Are customers paying for bursaries within their insurance receiving that funding back and that investment, or is it not being spent and there are missed opportunities? And there are different schemes and placements that you'll sit as a business within your risk transfer program, so your insurance program, and within certain schemes, and your broker will be able to advise you on this, is you may be sitting in the scheme where you're actually already entitled to a bursary, and that part of your premium is actually already allocated to be spent. And if you don't spend it because you're not aware of it, it just,
it's gone.
It's gone.
That happens a lot. Yeah, that happens a lot. I mean, that's typically on the larger broker side of things, isn't it? But I'm aware of hundreds of thousands, millions of pounds of that kind of funding that theoretically is available, but just isn't getting spent, which is a travesty, really.
It is, and it does the client an injustice. I would say there is more money unspent than there is spent, which means that there's something in the ecosystem fundamentally not working. And it is actually the disparity between what the client needs and what the insurer needs. And I would say that burden is actually on the broker to act as the intermediary to better understand, allocate and align the need of both parties. No, that makes sense. I think it's an interesting one, isn't it? Because, as you say, the client is interested in the long term, or should be, certainly. The insurer would I'm sure love to be partnering with that client over the long term, but in reality, often clients will move their insurance around, and therefore you are always going to temper any investment you're going to make. If you've got a contract with a client for the next 2 years, you're probably not going to be wanting to invest much money out of your own pocket that effectively will get a return from 3 and 4 years onwards, because that doesn't make economic sense, does it? So it's finding that balance, I suppose, and that's where I think hitting it at both ends does make sense, because if you can have an impact on your claims frequency, that can be immediate, or should be immediate,
but equally the defensibility can have very a quick effect as well. If a claim comes through, and actually you can start batting these claims away more quickly because you've got a raft of evidence to send over to the claimant solicitor, then that also will have an immediate effect. So I think the best approaches are ones where you try and come at it from both sides.
Absolutely, and also to have a conversation around the potential for a return of premium. There are many health and safety managers doing absolute wonders for their companies in reducing the hazards and accidents. And so at the term of the policy period, there potentially, if the underwriter agrees, a potential for a return of that premium. And I have seen this before. And the way that can work is, say on a premium of £100,000, there's potentially, up to £2,500, even £5,000 that could be returned at the end of the period. If your business is having fewer claims and fewer accidents. If there is a return of premium, it's usually on a condition it's reinvested into risk management for continual improvement. So again, it's worth having that conversation with the broker, and those kind of arrangements are usually agreed at an individual level on the judgment and the view of the underwriter. That kind of thing would usually sit outside of a scheme that the policy would be placed into.
Okay. Last question then. In terms of we've talked about how it works and what you can use it for. What, in your experience, is the kind of size of these bursary pots of money? Clearly it's going to vary. If you're a burger van, almost self-employed, you're not going to get much bursary versus if you're a PLC. But how does it tend to work in terms of coming up with the sizes of them?
Sure, that's a really good question. There's a rule of thumb that's around 2.5% of your premium could be available for management bursary. So individual clients should find out what their premium is and to think about what is the size of the pots potentially available to them. Now, there are many influencing factors that would change that 2.5%. In some cases, it could be greater. It could be, in many cases, a lot less. Across the piece, for mid-market and large corporates, the usual bursary amount will be around £2,500 to £5,000. In some cases, on the higher level, it can reach £10,000. In unique cases for multinational businesses, there can be bursaries for up to £50,000. Now that amount may be spread over 2 or 3 years, perhaps. So it depends on the longevity of your policy. But if you work on a rule of thumb, that there's about 2.5% potentially available at bursary funding.
But I think, in my experience anyway, it's something that you have to be of a certain size. Obviously for that. If you're a burger van and your insurance is £200 a year, then you're not really going to have 2.5% of that set aside, because there's nothing you can spend the 2.5% on. So it's thinking about being of a certain scale where you're spending enough on the insurance that 2.5% could be worth something. But bearing in mind, £2,500, that's quite a lot of money. You can do a lot for that. You can do a slip test for a few £100s, for example. So if slips and trips is your biggest area of risk, well, you don't need that much of a premium, 2.5% to cover the cost of getting a slip test done, for example. So it's always worth having that conversation.
Absolutely, and it can make all of the difference, because this isn't just about claims. It also leads into your business reputation, and it also leads into protecting the welfare of your customers, the customer experience, and of your staff as well. Things like slips. From one of the leading insurers suggested there was about £80 million a year in slip claims across the piece, which is a huge number. And if you look at the HSE, again, they sort of trend slips, trips and falls as one of the highest hazards. So it can make tremendous difference. £2,500 can really buy you a very different customer experience.
Yeah, yeah, and that's it. We focus a lot on the sort of negative side of risk, as in, the costs and the losses and things like that. But actually, if you manage your risk proactively, it should enable you to power your business forward in a positive way, as you say, with customer experience and protecting your reputation and all this other stuff. So I think that positive message is definitely a good one to wrap up on. Thanks very much, Chris. Really great session. If people want to get in touch with you to ask any questions or understand a bit more about what you're doing and stuff, what's the best way for them to do that?
You can contact me on LinkedIn. So I'm active and always on LinkedIn. So anybody can connect or follow or private message me. And I'm very passionate about helping people and saving lives, and that's why I'm in the industry. So I'm always willing to take time outside of the day job to help people get what they need to do the job better.
Good stuff. All right, Chris, thanks very much. And we, as I said at the start, we'll see you shortly with for another interview about about Oversea, the business you're working with now. But a really good session on risk management bursaries, which I'm sure will be very helpful to a lot of the audience. So thank you very much.
Fantastic. Thank you, Christian. Good to be on here.